Good morning and welcome everyone. Thank you for joining our webinar on understanding domicile and the upcoming tax changes in the UK. I am Victoria Lansfield, a global tax specialist here at Sale International, and today we will be exploring how domicile affects your tax obligations and what the future holds with the upcoming changes that were announced in the spring budget. If you have any questions, please type them into the chat box and I'll address them at the end of the session. Please take a moment to read the disclaimer on the screen. As this webinar will provide general information, it does not cover all individual situations. Please consult with a tax advisor for any specific advice.
Limited interpretation and is based on legislation as at this production date. Please do take a few moments to read the disclaimer in full.
All right, here is what we will cover today. We will do an overview of domicile and its current role in the UK tax, the major upcoming changes in tax from April 2025. We'll have a detailed look at transitional new FIG regime, the Labour Party's views on the changes, and planning through this uncertainty and changes. Right, let's get straight into understanding what domicile is and its current tax implications. To set the context, let's briefly review the concept of domicile. Domicile is a legal concept that determines the jurisdiction whose laws, customs, and rights apply to an individual. Domicile, together with tax residence, determines your tax obligations in the UK. They are separate entities, however. Currently, your domicile status affects whether you can claim certain tax benefits and how you will be taxed. A person can change their domicile multiple times throughout their life, but they can only have one domicile at any given time. Let's dive into the three types of domicile, technically four, but the original are three. The first one is domicile of origin. It is automatically taken from your father at birth or from your mother if you're born out of wedlock. It reverts if other domiciles are lost. The domicile of dependency applies to dependents under 16 who take the domicile of the parent they depend on, and it changes with the parent's domicile. The domicile of choice is if you're at 16 years old or older, you can adopt a new domicile, but permanently moving to another country with the intention to stay indefinitely. This requires cutting ties with your domicile of origin and establishing a permanent home in the new country. Deemed domicile basically means that you can be considered UK domicile for tax purposes if you meet two conditions. The first condition is that you were born in the UK with a UK domicile of origin. You left the UK and acquired a non-UK domicile, and then you happen to return to the UK. Then you're deemed domiciled for tax purposes. The second condition is that you have been a UK tax resident for at least 15 of the previous 20 tax years. Then you will still be deemed domicile in the UK. These rules of the deemed domicile apply to income tax, capital gains tax, and inheritance tax. All right, so under the current tax system and domicile, this is how you're taxed. If you're non-domiciled, you can opt for the remittance basis, which taxes you only on income and gains brought into the UK. So if you have income and gains that you earned outside of the UK and you choose to keep them outside of the UK, and you apply remittance basis, you will not get taxed on that foreign income and gains. Domicile also impacts inheritance tax with different rules for UK domiciled versus non-UK domiciled individuals. Claiming the remittance basis allows relief from UK tax on income and gains retained outside the UK. However, this typically means losing personal allowances, reliefs, and the CGT annual exempt amount. For higher earners, however, where personal allowance is already lost, this cost may be less relevant. Long-term UK residents may also pay a remittance basis charge to use for this basis. So if you have been claiming remittance basis and you've been in the country and tax resident for 7 to 12 years out of the past 9 years, you will pay £30,000 in a remittance basis charge. This will allow you to exclude foreign income and gains from being taxed in the UK. And if you've been resident for 12 out of the last 14 years, it is £60,000. In the spring budget 2024, this year, the Chancellor announced that from the 6th of April 2025, the remittance basis will be abolished. This is a major shift, moving towards a residency-based taxation system, meaning that domicile will no longer determine how you will be taxed on these foreign income and gains. UK taxation of worldwide income and gains will now depend solely on your resident status. The concept of domicile and deemed domicile will no longer affect income and gains from April 2025. The remittance-based taxation is going to be abolished. This means that if you're resident in the UK, you will face UK tax on global earnings and investments, irrespective of your domicile status. This is to be replaced by the new regime linked to a number of years of UK residency. It will be called the Foreign and Income and Gains Regime, FIG for short. This regime is to be open to anyone who meets the residence conditions, including those who would otherwise be considered to be UK domiciled. So if you meet the statutory residence test in the UK for the 4 years, then you will begin to be taxed on your worldwide income and gains. Additionally, the approach to inheritance tax is expected to shift from domicile-based to residence-based. This change will align with inheritance tax rules more closely with the resident status of an individual, potentially impacting how estates are taxed. To help ease the transition to this new system, several transitional rules have been put in place. The first one being a 50% reduction on foreign income in the 25-26 tax year. Individuals who are not going to be eligible for the new foreign income and gains regime, who had been taxed on the remittance basis previously, will be taxed on only 50% of their foreign income for the 25-26 tax years. Full UK tax will apply to all worldwide income from the 26-27 tax year. I want to put a note here that the Labour Party is likely to not adopt this transitional provision, but we will discuss this a little bit further in the webinar. The second transitional rule is rebasing of foreign assets. Individuals who are not UK domiciled or deemed domiciled by the 5th of April 2025 can choose to rebase chargeable assets to their market value as of 5th of April 2019. This means that only gains from 6th of April 2019 onwards will be taxable. It is uncertain if this option is available on an asset-by-asset basis or if it covers all assets held at that date. The third transitional rule is temporary repatriation facility for the 25-26 and 26-27 tax years. Basically, it means that individuals taxed on the remittance basis can elect to pay UK tax at a reduced rate of 12% on remittances on anything they bring into the UK of pre-6th of April 2025 foreign income and gains under this temporary repatriation facility, known as the TRF. This facility will not apply to foreign income and gains within trusts, however. All right, a crucial component of the upcoming changes is the new foreign income and gains regime that I spoke about, the FIG. Basically, it gives a 4-year window to remitting foreign income and gains into the UK. Under the new regime, there will be 4 years allowing the new arrivals to remit foreign income and gains without immediate tax implications. There will be a tax-free investment income. Well, Labour is considering an additional concession to make UK investments income tax-free during this 4-year period. This would act as an incentive for individuals to invest in the UK and could replace or supplement the remittance concession. After a 2-year period for remitting historic stockpiled foreign income and gains at a discounted rate of 12%, there will be a focus on encouraging the remittance of any remaining stockpiled foreign income and gains. Although specifics are yet to be detailed, an extension of this period or other incentives may be explored. It is vital to mention that there is some political uncertainty still with regards to the new foreign income and gains regime. The Labour Party has voiced their views on these changes, and there are concerns that the removal of the remittance basis and the restriction on excluded property trusts could place a significant tax burden on individuals who have previously benefited from these regimes. They argue that this might drive wealthy individuals to leave the UK, affecting the economy and investment. As such, Labour is considering including additional concessions, as mentioned earlier, to make the UK more attractive for investment. They've suggested that making UK investments income tax-free during the 4-year window would help mitigate potential negative impact and encourage high-net individuals to bring their money into the UK. Under the new foreign income and gains regime, individuals will not be taxed in the UK on foreign income and gains for the first 4 years, as we mentioned. They can bring foreign income and gains to the UK during this period without incurring UK tax and will not be taxed on non-resident trust distributions. However, they will not receive UK personal allowances or annual exempt amounts. From the 5th year, they will be taxed on worldwide income and gains. This applies to both individuals who were non-UK domiciled under the previous regime and those who, despite being UK domiciled, have lived abroad long enough to qualify for the new system. Basically, if you're a UK tax resident and you move abroad, there'll be a 10-year window where you have to be abroad before you can reignite this new foreign income and gains regime, where you'll be seen as a new tax resident into the UK. This is not limited to people who have been non-UK domiciled under the pre-6th of April 2025 regime. It is to apply equally to those who would have been considered UK domiciled but have lived outside the UK long enough that they qualify for this new regime. For example, this would include UK domiciled individuals who have been working overseas for a decade or more before returning to the UK and resuming their UK residence. Years of UK tax residency under the statutory residence test prior to the 6th of April 2025 will be counted when deciding whether the individual qualifies for the new regime. However, unlike under the existing remittance basis, split tax years and years of treaty residence are expected to be ignored. So be very careful when considering if you qualify for the 4 years. Right. Planning for the abolition of the remittance basis. To plan for the end of the remittance basis, some might consider realizing foreign income and gains before the 6th of April 2025 and keeping the funds abroad. However, this could lead to tax issues in the source country and might not have the desired effect. Since the new rules were not in place before the general election 2024, the proposals from the spring budget, especially the transitional rules, could change before they become law. There might also be new rules introduced as of the spring budget 2024. That could prevent any efforts to lower tax liability through early planning. This uncertainty makes it difficult to plan effectively before the changes take effect. However, it is advisable to begin planning for new scenarios, as there is certainly an opportunity to tax plan effectively during this change. A recent example where we were able to save our client roughly £80,000 in tax was we advised her to withdraw her retirement annuity funds from South Africa before the 6th of April 2025. This way, she could claim the remittance basis for this 24-25 tax year, avoiding UK tax until the income is remitted. If she chose to remit those funds immediately into the UK, it would have been taxed at her marginal income tax rate, which would have been 45% in the UK. We advised her to hold these funds in South Africa until the transitional rules took effect, allowing allowing unremitted income to be taxed at the reduced rate of the 12% in the 25, 26, and 26, 27 tax years. So if she chose to withdraw the money in the current tax year, claim remittance basis, and then wait until 25, 26, or 26, 27 years to bring that money into the UK, she will only be taxed at 12% versus the 45%. This resulted in a tax saving of 33%, or if remitted immediately, 10%, 10.5% if withdrawn in the 25, 26 tax year. No foreign tax credits from South Africa could be used to reduce the 12% UK remittance tax rate. It is important to note that. So when you're planning and thinking of how you're going to bring in your money, do the calculations, do the scenarios. As I said, it is all still a little bit uncertain. So do be as cautious as possible. But there is huge opportunity to plan during this period. I want to discuss a little bit more on how the foreign income and gains regime will work. Again, you will be 4 years considered a tax resident, but a new tax resident, therefore your foreign income and gains will be excluded from UK tax. However, you have to be very careful on how those 4 years are looked at and considered and tested. So it is always advisable to speak to your tax advisor. We have covered a lot of ground from the new foreign income and gains regime that offers tax reliefs in the first 4 years of UK tax residency. The transitional rules, including the reduced tax rates of foreign income for the 25-26 tax year, rebasing of foreign assets, and the temporary repatriation facility. A few options, like we discussed in the example, would be to consider foreign income gains before the change comes in on the 6/25. That way you can still claim the remittance and then proceed on to plan ahead and potentially bring it in at the 12% in the next 2 tax years. Or if you're coming into the UK still, to plan on when you will enter so that you meet those 4 years appropriately and protect yourself from tax on your foreign income in those first 4 years that you've moved to the UK. Also, if you're leaving the country to work abroad, another potential is to plan for the next 10 years to re-trigger your new tax residency into the UK, allowing you to make use of those first 4 years again. So there is a lot of scope to plan and to avoid hefty tax fees and to make use of these lower rates. However, again, I have to urge you to be cautious and plan appropriately and cater for various scenarios. Thank you all for joining today's webinar. Understanding these changes is crucial for your tax planning. I hope what we discussed today may be a bit short, has given you a brief scope into what the new regime will look like and what the domicile means for you and what the abolition of domicile could mean for you specifically. As always, staying informed and proactive is key with the potential for policy changes, such as those proposed by the Labour Party. It's important to keep abreast of the latest developments to ensure you're making the most of the available tax reliefs and minimizing your tax liabilities. If you have any questions, barring what we will speak about in today's webinar, please don't hesitate to reach out. Our team is here to help you navigate the changes and provide tailored guidance for your individual needs, as each case is very different. How we can help, we can assess your situation and advise. We provide a free 15-minute assessment. We want to make sure we speak to you and understand your circumstances before we even delve into doing any work with you. So please feel free to reach out. Let's discuss your situation and take it from there. We will share these slides and it will be a link to booking a call with us. Right, let's jump into any questions. Let's see if anybody has put any in the chat. Right, I see no questions at this time. I will answer a few common ones for you to possibly help, but please feel free to post any in there or contact us after this to discuss. A common one is, what is the difference with residency and domicile? As I mentioned earlier, residency has to do with the tax residency tests of the UK, the statutory residence test, automatic residence test, versus domicile, where that is more to do where your parents came from, where your home is, and domicile is a more permanent situation where tax residency can change each tax year based on how long you spend abroad and certain circumstances that you meet with ties to the UK. Great, we have a question in the chat. The question is, if you don't make use of the remittance bases already, are there any actions to take? Yes, certainly. The remittance basis is not you have to do it right off. You can make it, you can choose to use it year by year. It's not exclusive. So you don't, if you use it this year, you don't have to use it the year after or the year before. So it is a case by case, and it all depends on what you need to bring in or what you have earned outside of the UK. Right, let's see if there's any other questions. Right. No other questions at the moment. Let's see if there's any other basics that we can think of. But the main key point that I want you all to take away from today is that the way that foreign income is taxed is going to change in the UK. There is still room and scope to plan for this current tax year and the next few. And please do take the opportunity to do so. Speak to your tax advisors, come speak to us. Let's see how we can assist. There is a lot of room to minimize these hefty tax rates, which could be up to the 45%. Let's take advantage of that. But yes, please be on the lookout on what you bring in. Don't just assume it will all be just automatically taxed in the country that it is in. Take a moment to consider that if you're tax resident in the UK, they might have the right to tax you again on your foreign income and tax. We have another question. Is there any impact on straight capital moves? Yes, there is an impact. So that is where the transitional rule comes into effect, where they say that you could potentially rebase your assets at that 2019 value, so that any new gain that happens can be taken from that point, not as if the original base cost of that asset. There are things to consider also of how long you've been tax resident, because if you weren't always tax resident, there might be the base cost might also be looked at from when you became tax resident, not necessarily the original acquirement of the asset. I hope that answers your question. I'll give it one more minute if anybody has any other questions. Otherwise, we will thank you for joining us. Right. There don't seem to be any more questions. Thank you, everyone, for joining us. I hope it shed a bit of light. Great. We will speak soon. Thank you so much.